Hello ISHR students, welcome to the next video in our video lecture series. Now that we've finished macroeconomic goals, we will be moving on to macroeconomic policy. There are three types: fiscal, monetary, and supply side policies. Today we're going to be going over fiscal policy. This video lecture is designed to supplement your textbook. If you are struggling with this material, hopefully this lecture will help you cover all of the key information and material that IB wants you to know based on the IB curriculum standards. And so before we even get started with fiscal policy, what is it? How does it work? I think it's important to define what are those IB standards? What are you supposed to know, or what should you have learned based on fiscal policy according to IB? So let's quickly go over what I hope you know or will have learned by the end of this video lecture. First, sources of revenue. IB wants you to understand where the government gets its funding. Where does it get money to finance its spending? Secondly, types of expenditures. When the government collects that revenue or collects money, how do they spend it? What are the different types of things they spend it on? Thirdly, budgets. When we look at revenue and expenditure, it ultimately relates to a budget. And what is the difference between a budget surplus and a budget deficit? Next, and very importantly, what is the impact of government policy upon aggregate demand and ultimately, the macroeconomic level of output and inflation? And so basically, how does fiscal policy impact the macroeconomic outlook? How does fiscal policy, how can it lead to growth, and how might it not lead to growth, economic growth? Another concept associated with fiscal policy that you need to understand is something called automatic stabilizers. IB is one of the many IB standards, so we'll be going over that as well. Similar but definitely different, something called crowding out. And finally, the strengths and weaknesses of fiscal policy. So we'll be trying to cover all of this information. So hopefully by the end of this lecture series or this lecture, you'll know something about each of these points. All right, let's get started. Fiscal policy. What is it? What is fiscal policy? Well, you probably know that it has something to do with the government. And if you thought that, you were right. Basically, it's defined as the manipulation of government expenditures and taxation to influence aggregate demand. It is also known as a demand-side policy. And so fiscal policy, basically the government uses taxation and government spending to impact the macroeconomic outlook, to try to promote growth or to try to slow down inflation. It can use what's called expansionary or contractionary monetary policy, which we'll be going over a little bit later. Anyway, so I guess before we get into how government spending and works and how that impacts the economy, we need to understand first, where does the government get its money? Where does the government get funding for its spending? And think about it for a second. It's already on the page. You probably know this. How does the government get money? Taxes. There are two types of taxes. There is direct versus indirect taxation. Direct taxation is a tax directly placed or levied directly upon income, so something like income tax. And indirect taxation is defined as a tax on consumption or a tax on expenditure. Something like a sales tax, or in Germany, a Mehrwertsteuer, or something like that. So again, direct taxation, a tax on income; indirect taxation, a tax on the sale of goods and services. And if you think about it, you probably know that there is a sales tax in this country and there is a income tax that people pay to the government directly from their paychecks. There are other forms of taxation the government collects as well, such as corporate income tax, which is tax on the profits that corporations make, capital gains tax, which is taxed on the money that is earned from the sale of assets and it is treated like income. There's lots of different ways, but the main two that IB wants you to know is direct versus indirect, and like we said, it's either on income or on the sale of goods and services. So those are two ways that the government can earn money, and there's one other method. It's called privatization. The government can sell government-owned institutions, assets, or enterprises, which is just another word for businesses. And when the government sells these institutions, businesses, assets, they can earn money from the sale of these enterprises. For example, certain industries used to be more heavily regulated by the government or completely government run. But then the government, decided to maybe that it was too costly, or they weren't managing their resources effectively, and so they sold those companies to the private sector. A good example of this would be maybe like the telephone industry, or in the past, airlines were very, very heavily regulated, and a lot of them have now been turned over to the private sector. So anyway, this is another method that the government can use to increase its revenue. Let's move on. So when we look at the government collection of taxes, we could look at, for example, the UK, and you can kind of see where all these different taxes, how they contribute to the whole pie of what is government revenue. And so you can see that they get 2% on alcohol, they get 2% on stamps, they get fuel, there's gas taxes, which are embedded in the price of gas, there's corporate tax, there's value-added tax, there's income tax, there's all sorts of different taxes that the British government levies on its citizens and companies, and those different taxes are used to finance government expenditure. And so that's just one example. Different countries have different breakdowns of tax rates and different things that they tax. Anyway, moving on. It's a quick question: what might the government tax differently during a recession? If we had a Wirtschaftskrise, a recession where the economy was performing very poorly and GDP has been going down, how might the government change its tax policy? I want you to think about this, and we're going to talk about it in class. Something just to reflect on. Okay, moving on. So as we said, the government has, it collects money through direct, indirect taxes and privatization. And that money that it collects is used to finance its expenditures or government spending. There are three types of expenditures. The first type of expenditure is called a current expenditure. A current expenditure is basically short-term spending. And it's defined again as government spending on everyday goods and services that last a limited time. Education, forestry, police, the fire department. These are things like spending on when you spend on a teacher's salary or a fireman's salary or a policeman's salary, or on materials like paper or things that are designed to be used less than a year usually. Used and used up in less than a year. So again, these are current expenditures. The next type of spending is called capital expenditures, and this is spending on permanent assets, a hospital, a bridge, a government building, a road, a highway. this is what's considered long-term spending or permanent spending on resources or goods that will last more than a year. So again, the two main types of expenditures are current and capital. And just note that one is very short-term and one is much longer-term. Finally, the third type of government spending is called a transfer payment. And basically it's defined as a payment to an individual from the government for which no good or service is exchanged. Things like Social Security, welfare, unemployment. In Germany, this would be called Hartz IV. This would be Arbeitslosigkeit, money that the government spends on unemployed, doles out to people that are out of work. These are just different examples of transfer payments. So again, the three types of expenditures are current, capital, and transfer payments. Just kind of a quick note, transfer payments are typically not calculated in GDP. They're left out. More on that later. Okay, so back to the UK, we can see that the government in 2011, I think, spent about 4.7 billion pounds on capital spending, where they spent almost 52 billion pounds on current spending. So you can see they spent a lot more on current spending, things like health and education, justice, all these different things that it spent money on, versus capital spending on roads and bridges and buildings associated. Long-term spending was a much smaller piece of the government budget. But yeah, just to kind of give you an idea of how the government spent the money that it earned or that it received from taxes and privatization. The next thing that we have to talk about in relation to government spending and taxation has to do with what's called a budget. A budget is basically looks at sources of revenue and sources of and expenditures. And as you can probably imagine, when revenue is equal to spending, we have what's called a balanced budget. However, many governments around the world, and this is just common everywhere, many governments spend more money than they receive in taxes. When this happens, this is called a budget deficit. As you can kind of see in this cartoon, which is sad but true, many governments, this deficit just keeps getting bigger and bigger and bigger, and it can be very problematic. Let's talk about these three things. Okay, so again, a budget deficit. What did we just say it was? It is when government revenue is less than government spending. We basically have a budget shortfall. Again, and if this is happening, the government might have to borrow money, and this is sort of goes into what's called government debt. All the money that the government owes to its creditors or people that have lent it money is from budget deficits largely. When is a budget deficit likely to occur? When does the government not have enough money to spend on all of its goods and services? A recession. Think about it. During a recession, fewer people are working. They have to spend more money to help out with the transfer payments like Arbeitslosigkeit or unemployment, or money on welfare programs for people that aren't earning enough income. So again, they're spending more, and those people that they're giving the money to often don't have jobs, so they're not paying taxes. So during a recession, the government tends to collect less in taxes because not as many people are working, and also we have more people that need financial assistance, which the government gives. So again, this is typically when a budget deficit is likely to occur. Well, what's dangerous? As we said, if you have a big deficit, that goes into your debt, and over time that debt gets larger and larger. And if you look at certain countries, like, for example, Greece or Japan, their deficits are very large and their debt is enormous. And it is so large that people are a little bit shy or sheepish about lending money to these countries, because at some point you kind of worry, are they ever going to pay back the money that they owe? When their debt level is so high, it looks like it might be unmanageably high and that they might default, meaning they just won't pay their bills. So this is again a sort of a scary thing that's associated with budget deficits. If they are allowed to persist for years, we can reach really high levels of debt. And again, when kind of what's happened with Greece and maybe what's happened with Japan a little bit too, when you have really high levels of debt, investor and consumer confidence tends to be a lot lower. People see that debt and they think, okay, the government is irresponsible, or it's not managing resources effectively. I don't want to invest in a country that doesn't look like it can pay its bills. Or, for example, governments issue bonds, and if you see that a government has really high levels of debt, you might be reluctant to buy that government's bonds because you're worried that the government won't actually be able to pay back what they owe. So again, this is problematic. And just to kind of give you the other side, a budget surplus would be when government revenue from taxation and privatization is greater than government spending. Governments generally don't have surpluses. If they do, it's usually used to pay down the debt. But again, a government surplus, the government doesn't exist to make money, it exists to serve its people. So either that, they should, if they have surplus funds, they should lower their taxes so their people have more money to spend and have higher living standards, or they should use that money to pay down their debt. Okay, let's do a quick quiz. Let's see if you got anything out of the last so many slides. First, what are the three sources of revenue for governments? Where do they get their revenue? Think about this. You just saw this. What are the three sources? You got it? It's direct and indirect taxation and privatization. And do you remember the difference between direct and indirect? What are they taxes levied on? And what is privatization? Take a moment. Think about it. Write it down. Remember that direct tax is a tax levied on income. Indirect tax is tax levied upon consumption or the sale of goods and services. And finally, privatization is the sale of state-run enterprises or assets. Okay, what are the three types of expenditures? What are the three types of expenditures? Write it down, see if you can remember. There were three types. What were they? Write it down. Okay, you got it? They were current, capital, and transfer payments. Or sorry, current expenditures, capital expenditures, and transfer payments. Hopefully you got that too. What's the difference between current and capital expenditures? Maybe go back, make sure you've got that. What are some examples of transfer payments? Okay, one last question. What is a budget surplus? What is a budget surplus? When something is greater than something. Okay, and it is when government revenue is greater than government spending. We have a budget surplus. Okay, like we said, if the government does have a surplus, which again is rare, it would be used to pay down the debt typically. If not, maybe it could be given back to the taxpayers in the form of a tax break, or it could be used to fund new construction or new capital goods, or a lot of different things. Finally, a balanced budget would be when government spending equals government revenue. So again, it's basically spending equals revenue. We have a balanced budget. It would be nice if all governments were responsible and had balanced budgets, but this just isn't the case. Okay, so this is the first of 3 in the video series. I'm going to go ahead and take a quick break. Also, I'm limiting the size of the files because, again, if they get too big, they take up too much space. So this is the first of 3.